Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 286. Global currency turmoil. So we are seeing huge currency movements, whether it is Japanese yen, whether it is Chinese yuan, whether it is Indian INR. Because the dollar just keeps on strengthening. The dollar index has crossed 111, and the entire world is just waiting and watching what the dollar will do in the short term, because it is just extending its run on the upward side, and that is causing a huge amount of flows to go out from all other risk assets into that safe haven, and that is causing liquidity crisis worldwide. There's a lot of dollar denominated debt that has been issued even outside the US, and with crashing currencies that debt becomes even more difficult to pay back. So it is like, the dollar is on one side and all assets, all currencies are on the other side, and the dollar is just pushing harder and harder. So a global currency crisis is currently on. How it will resolve and how the things are moving, we will discuss in the second part. But first, a look at the markets. Markets are very volatile today. While Nifty closed 0.5% down, overnight news or cues from the Fed and from the Asian markets in this morning were extremely weak. The Fed hiked 75 basis points, and despite it being expected, the hawkish statements caused the US markets to fall quite badly. Nasdaq also fell almost 2%. So it was sort of a given that all Asian markets will fall in tandem. Nifty in fact fell only 0.5% in the morning, recovered back almost all the losses, then fell down more than 1% to recover back about minus 0.5%. So a lot of yo-yo movement in the day today. Banking giving up most of the gains, or I would say losing the most today, and banking has been leading the rally. Banking in the last 1 month, PSU banks especially are up for 14%, private banks are up 6.5%. These are the top sectors that have been doing well, along with metals and consumption stocks. So consumption, FMCG, autos and metals still did all right today, but energy, real estate, infrastructure, commodities, banking, they all lost some ground. In terms of the broader indices, small cap index was quite robust, plus 0.5%, along with Nifty Next 50 and mid cap small cap index. CNX 500, CNX 200 were down by about 0.25%, and Nifty was down 0.5%. In terms of weekend investing small cases, a very surprising performance, all of them in the green, with MI35 taking the lead at 1.65%, MI80H up 1.5%, MI80H2 up 1.4%, MI EverGreen up 1%. So very hearty outperformance today by almost all strategies, even by MI India Top 10, which closed at 0. Although the Nifty has closed minus 0.5%. So very, very good performance by momentum strategies today, despite the weakness. And you can see the weakness on the heat map. The entire banking and finance sector deeply red. Reliance, ONGC, Coal India also losing out. ITC levers, Nestle doing well. IT surprise package, despite a weak Nasdaq, remaining reasonably steady. Autos reasonably steady. Pharma, after run yesterday, some profit booking here and some profit booking in cement and steel as well. Other than that, some power stocks, NTPC, Power Grid also lost some ground. In terms of gainers, Suzlon Energy again 12% up, KPIT on that acquisition up 11%, Aptus Value up 6%. Sri Renuka Sugars up 6%, and Hitachi Engineering also up nearly 6%. On the downside, Fortis Health, dramatic fall today, almost 15% down. Suntech Realty minus 5% down. India Cements after a huge run up minus 4%. Varroc Engineers and Sona BLW also down nearly 4%. In terms of where we stand on the Nifty, so we've tried to cross this trend line 3 times, but we've kind of failed to do so. We are still not dropping as such, but the weakness in the global markets is causing a sideways sort of time correction in our markets, and this is also sort of coming close to the result season. So maybe next month is when the real moves may happen, upwards or downwards. That's anybody's guess, but the choppiness is continuing for now. As I mentioned, there's a huge amount of volatility in the currencies as dollar index is strengthening, and the yen has been weakening a lot from a low of 75 odd in 2012, and very recently almost 105, and now it is 142 suddenly within a year and a half. So if you see the very long term pattern, yen was 360, US dollar to a yen was 360, and then it dropped to almost 75. So yen was strengthening all this 40 years of its existence, and then now it has started to weaken a lot. And today the Central Bank of Japan has intervened in the market for the first time in like decades, and they have sold dollars to try and strengthen the yen, but there's hardly any impact of that yet on the markets. So also currency turmoil and increasing interest rates is causing extreme bearishness and hawkishness on all markets. This is the heat map from the morning for our markets, opened down a bit, but this on the right side is the S&P 500. You can see it's a sea of red out there. This is the main reason why the world is topsy-turvy right now, that the dollar index is going out of control. From a level of 75 in 2008, it had stabilized in this 90 to 200 region, but this year it is just going very up dramatically. And you can see here that in 1980s, for about 5 years, dollar went through a huge spike up. This was the high sort of inflation period, and interest rates in the US went up to 20% at that point, and they threw everything at the interest rates to try stop this huge inflation happening. And again in 95 to 2001, when this huge USD rally happened, there was a huge Asian currency crisis, and that Asian currency crisis led to dramatic falls in many Asian markets, and a lot of defaults on dollar denominated debt in the Asian region. So this is again a very potent move. We don't know where it will go. It's go to 120, 130, 140. I don't know where it goes, but the more it goes up and stays up, the more likely it is that emerging markets are likely to have some problems or the other, because the world is washed with dollar denominated debt. We have loved the dollar so much that everybody and their grandmothers have taken dollar loans, and once their own currencies start to weaken, servicing that dollar loan becomes an impossibility. So this is something called the Triffin's paradox also. So please read about this, that when a country's currency is also used as a global reserve currency, it is also a trouble for that particular country. So US is in no sweet boat, although their currency is strengthening, because they don't have much of manufacturing left in the US. So they have to import everything, and they have to their US corporations are exporting to the world. So they will have to very quickly start to build in the US and export from the US if they want to take advantage of the stronger currency. Otherwise, the stronger currency is not helping them if all the manufacturing bases remain outside, and the Americans have to use those bases outside. Like, just for example, yesterday there was this announcement that Apple is going to shift a lot of iPhone capacities to the Indian shores in the next couple of years. So they want to build in regions where the currency can be a bit softer. So a lot of issues for both sides, for the US as well as for India and for other emerging markets. There is, of course, no immediate solution. In terms of investing in various currencies, a lot of people in the last few years, maybe because of the rise of Nasdaq or S&P 500, have been thinking that we wish that we would have invested in the American markets. We wish that we had invested in the US stocks. But this is a 30-year chart of Nifty in dollar terms, which is the black line, and the pink line is the S&P 500 in the US, obviously in dollar terms. And you can see there is no difference. What we have achieved in 30 years in INR, in dollar terms in Indian markets is the same as what you would have achieved in the US markets. So, on a long term basis, there has been no difference. Of course, if you had timed it well, where when the US market went for a flat phase between 2000 and 2013, you could have been invested in INR in Indian markets and gained more. So, switching between the two at the right time would have made a lot of sense. But of course, how many of us are good timers? We all know that. But on a longer term basis, this is making no difference. But on a shorter term basis, let's say since the year 2000, Nifty in dollar terms is up 600%, whereas S&P is up only 200%, over 178%. So Nifty, even in dollar terms, has done extremely well in the last 2 decades also. In the last 3 decades, we saw that they have done equally well. In the last 2 decades, approximately, Nifty has outperformed by a big margin. So, last 20 years, if you have been investing, you would have done really, really well. In the last decade or so, Nifty in dollar terms has underperformed somewhat by S&P by a smaller margin. So 130% on Nifty versus 169% on S&P 500. And since COVID, S&P is up 54%, whereas Nifty in dollar terms is up 113%. So, Nifty has there is no reason why we should be looking out for investing in the US market, just because the narrative is such that US markets are a better place to invest. I've shown you with examples over 30 years, over 20 years, over 10 years since COVID. In most situations, Nifty in dollar terms has done very well, and Nifty, of course, in INR terms has done exceptionally well. So from that perspective, stay invested in India, there is no problem. And for the current calendar year, I don't have to say anything. Nifty in dollar terms is down 6%. S&P is down 20%. So, even this year, for the year-to-date results, we are doing well. And USD INR is breaking out. Today, it broke out of a consolidation of 3 months below this trend line. And we've already suddenly from 79 odd to 81 or 80.8 today. And if this sort of flagpole sort of situation plays out, I think we are going towards 85 or something like that. But this is a huge breakout. And we need to also protect ourselves from a currency crisis if that comes around. So we need to have USD based assets, and gold is one of them. Also, in inflationary and currency crisis times, real estate does very well. Companies that have great cash flows, low debt, good market share also do very well. Quality companies. So we have to find the right vehicles that can protect us in this very turmoil oriented macro environment. I mean, this is not no smooth sailing anymore, and I don't think that smooth sailing will come anytime soon. So we need to keep ourselves protected by asset diversification, asset allocation, and within equities, I would strongly urge that even in case you are not doing momentum investing, please have some plans of action if and when market will go against you. There needs to be a framework, otherwise the market will swallow you alive, as it does to 98% of people who don't have a plan. So thank you so much for watching this. I hope you are sharing this with your friends and family. You have been giving fantastic feedback on the YouTube comments. Thank you so much for that. I try to answer or respond to them, but I may miss out on some. So if I do miss out on any query, please do send us the same query on support@weekendinvesting.com, and I look forward to doing more of these. Please do forward this or share it with your loved ones. Thanks. Bye.